Every commercial real estate sale looks simple from the outside. A property changes hands, a check gets written, everyone shakes hands and moves on. But underneath that simple picture is a process with a broker who's actively managing it at nearly every step. In this video, we're going to walk through that process at a high level and show how a commercial property actually gets marketed, negotiated, and sold. The process starts with a listing broker, the broker representing the seller. Sellers typically select a listing broker by interviewing a few candidates and comparing their track record with similar properties, their knowledge of the local submarket, and the marketing plan and pricing strategy each one proposes. The decision usually comes down to a mix of demonstrated results, rapport and trust with the seller, and the commission terms the broker is willing to negotiate. Before a single buyer ever sees the property, the listing broker is doing preparation work behind the scenes. The centerpiece of that preparation is the offering memorandum, or OM. Think of the OM as the pitch book for the property. It's a detailed marketing package built to answer every question a serious buyer is going to ask. It includes a description of the property, a financial summary, including things like the rent roll, the NOI, that is net operating income, and expense history, and market data that shows how the property compares to similar assets. It will also include a narrative investment thesis, which is really just the broker's case for why this would be a good investment. The goal of the offering memorandum is simple: to give qualified buyers everything they need to evaluate the deal without a dozen back and forth phone calls. Once the offering memorandum is built, the broker moves into the marketing phase. The offering memorandum gets distributed to a pool of qualified buyers, not just one interested party, but a curated list of investors who are actually in a position to close a deal like this one. These investors could be local, regional, or national investors who have a track record of buying similar properties. From there, the broker is managing the whole marketing process. They're fielding inquiries, coordinating property tours, and keeping track of who's seriously interested versus who's just kicking the tires. As offers start coming in, the broker helps the seller evaluate them, not just on price, but on things like financing certainty and closing timeline. This is where a good broker earns their fee, working to create enough competitive tension among the buyers to get the seller the best possible outcome, and advising the seller on strategy along the way. Once a buyer has been identified, the next step is the letter of intent, or the LOI. This is an important document to understand because it's non-binding. Neither side is legally locked in yet. Yet think of the LOI as a framework for a deal, not the deal itself. It lays out the price, the due diligence period the buyer will need, the earnest money deposit, and any key contingencies, things like financing or environmental review that need to check out before the deal moves forward. The broker typically helps negotiate the LOI, and once both sides agree to these high-level business terms, the LOI paves the way for something much more serious, a legally binding contract. That binding contract is called the Purchase and Sale Agreement, or PSA. This is where things shift from negotiation to execution. The Purchase and Sale Agreement specifies the actual legal duties of both the buyer and the seller. And unlike the offering memorandum or the letter of intent, this document is typically drafted by attorneys, not the broker. That's an important distinction. The broker's expertise is in deal making and market knowledge, not in legal drafting. Once the PSA contract is signed, the buyer moves into due diligence, inspecting the property, verifying financials, and confirming everything the offering memorandum claimed. The broker's role shifts too. Instead of marketing and negotiating, the broker is now coordinating, keeping the due diligence process moving, keeping everyone communicating, and working to keep the transaction on schedule all the way to closing. Now everything we've just talked through scales up significantly at the institutional level. Commercial brokers who work in the capital markets division handle the sale of income-producing properties to institutional investors. Things like REITs or private equity funds, pension funds, family offices, and sophisticated private investors. These aren't backyard deals or mom and pop deals. They require real financial modeling skill, a working knowledge of the debt markets, and relationships with institutional capital sources who can actually find and fund a purchase at this scale. At this level, brokers present properties using cap rate analysis and discounted cash flow projections, tools that let institutional buyers evaluate value the same way they'd evaluate any other investment. So whether it's a single retail building or a multi-$100 million office tower, the shape of the process is the same. Prepare, market, negotiate, sign a binding contract, and close. What changes at the institutional level isn't necessarily the process, it's the sophistication of the analysis behind it.